Good afternoon. Welcome to the online briefing of Standard Chartered Hong Kong SME Leading Business Index, the second quarter of 2022. Let me introduce our two speakers today. They are Mr. Edmund Lai, Chief Digital Officer of Hong Kong Productivity Council, and Mr. Kelvin Lau, Senior Economist, Greater China, Global Research, Standard Chartered Bank Hong Kong Limited. Our speakers will explain the index and survey results of this quarter, followed by Q&A session. You may raise your questions using the Q&A function of Zoom or later in the Q&A section. So now, let's welcome Edmund and Kelvin for the sharing. Edmund, please.
Thank you everyone for joining today's online conference. The Standard Chartered Hong Kong SME Leading Business Index is a quarterly survey being conducted by the Hong Kong Productivity Council independently. It is being sponsored by Standard Chartered Bank Hong Kong Limited. This quarterly survey consists of two parts. The first part is to analyze Hong Kong's confidence in recent business environment. The second part is the featured topic, which will be different for each quarter. This time, the featured topic is to investigate SMEs' planning and action on the fifth wave of epidemic. Now, let's look at the three key points of the second quarter of 2022. This quarter's survey was conducted at the end of March when many economic activities in Hong Kong were almost at a standstill due to the fifth wave of epidemic, leading to the expected downturn in the index results as the market was very pessimistic at that time. The Q2 overall index is only 35.7, dropped 12.4 from the last quarter. This is also the biggest drop in a single quarter in the history of the index. 76% of SMEs reported a decrease in income with the impact of the fifth wave of epidemic. 46% of SMEs have suspended their businesses or could only last for 6 months because of the fifth wave of epidemic. Now, as the epidemic situations continue to stabilize in Hong Kong, it is believed that the business environment will also recover. Now, in the part 1 of the survey, as you can see that the overall index is only 35.7, which is not only a big drop, but also if you look at the previous 4 quarters, this is also at the lowest point. The overall index consists of 5 component sub-indices, which are recruitment sentiment, investment sentiment, business condition, profit margin, and global economy. In this quarter, all 5 component sub-indices dropped below the neutral level of 50, in which the sub-index global economy recorded the most significant decline. Now, considering the fifth wave of epidemic and the global situation, the result is perhaps not really a surprise to anyone. Coming next, let's look at the 3 major industry indices. Manufacturing industry index declined by 11.3 to 33.6. All 5 component sub-indices also dropped, in which global economy component sub-index dropped for 4 consecutive quarters. Import-export trade and wholesale industry index also declined by 9.6 to 35.9. All 5 component sub-indices also dropped, in which we see that the profit margin component sub-index recorded the biggest drop. Retail industry was also being hit very hardly. Retail industry index dropped by 14.8 to 31.2, and also all the 5 component sub-indices also dropped. And you can see that business condition component sub-index recorded the biggest decline. From this quarter's survey, we can see that Hong Kong SMEs are facing more and more pressure from inflation. 74% of SME expected raw material costs will increase in this quarter, which is already the 7th consecutive quarterly increase. Although most SMEs expect staff salary costs won't increase, only 26% SMEs expected their product or service price will increase. It means that most SMEs have to bear the cost increase by themselves, which will increase their pressure on cost and may eventually impact their profitability. For the investment outlook, 18% of SMEs expected a decrease on overall investment in the coming quarter, which is double from the last quarter. But if we look into the investment item by item, we can see from the right-hand side of the chart that more than 70% of SME will continue to invest in IT related to e-commerce or operations, R&D, and equipment and facility, which are all related to the longer-term competitiveness of a company. On the other hand, if you look at the left side of the chart, we can see that the investment cut is more on inventory, marketing promotion, and office, factory, store, etc. Now here we come to the second part of the survey. The feature topic in this quarter is to look at how Hong Kong SME deal with the fifth wave of the epidemic. The survey result showed that 76% of SME reported a decrease in income, and the top 3 industries being impacted are social and personal services, retail, and accommodation and food services. And this is perhaps really within our expectations. And due to a decrease in income, 70% of SME indicated that they need to cut down on cost. And the major way on cost saving is to downsize the business, which accounted for 45%. The other 2 measures are to explore other suppliers and also leverage on technology. Due to the tight anti-epidemic measures resulted from the 5th wave of the epidemic, 46% of SMEs have suspended their business or could only last for 6 months at most if the very tight anti-epidemic measure will continue. The 3 most impacted industries are accommodation and food services, social and personal services, and retail. But now, as the epidemic gets more stabilized here in Hong Kong, more and more people are coming out for shopping and other activities. So this will restore SMEs' confidence in the Hong Kong business environment. For the 3 most impacted industries under the 5th wave of the epidemic, each one of them has their own way to deal with the income decrease. Now, for accommodation and food services, the top measure is to apply for government funding, followed by offering price discount and apply for loan. And for social and personal services, the top measure is also to apply for government funding, followed by providing a digitized service via the internet, offer price discount, and apply for loan. And for retail, the top measure is to offer price discount, followed by taking the advantage for the new consumption voucher scheme offered by the Hong Kong SAR government, and to apply for the government funding. In this featured topic, we also asked the SMEs their views on the new consumption voucher scheme. For the 3 most impacted industry under the 5th wave of epidemic, 67% of retail and 65% of accommodation and food services SMEs believe that they could benefit from the consumption voucher scheme, while on the other hand, only 20% of social and personal services SME indicated that it will be helpful. To support Hong Kong SMEs, Hong Kong Productivity Council recently also offered a 50% price concession on the labor cost for R&D, consultancy services, and testing services, and also the venue charges on HKPC facilities. We believe that our client, making use of digital technology and other advanced technologies such as Industry 4.0, can help them to reduce costs, improve productivity, and develop new products. We have many successful cases, and we strongly believe that it is crucial for the SME under the new normal to be able to make use of technology. You can scan the QR code on the screen or visit our website to get more details. Now, in the next session on the experts analysis, I'll pass on the time to Kelvin from Standard Chartered Bank.
Thank you, Edmund. Good afternoon, everybody. So thank you for joining our press conference today. So for my part, I would just like to echo what Edmund has mentioned just now, and that is overall, there's just no way of sugarcoating the results of this round's survey, where things do look pretty weak across the board. Not only if you look at the headline index, it fell by a record 12.4 points, and by saying that it's a record drop, we're talking about an index history, a survey history that goes back all the way back to 2012. So it does give us quite a large history base to compare with. And this is the largest this time around. And also, you look at the sub-indices, the 5 index components, and also the 11 industry sub-indices all dropped quarter on quarter. So it does shows us a very broad-based decline, and no industry is immune from this setback. Obviously, the main reason is associated with the 5th wave of the COVID outbreak in Hong Kong and its disruptions, as our survey being conducted in March allowed us to capture this peak COVID disruption period. But if we really squint and try to look for bright spots, I think there are two small ones. First of all is that even with a record quarter-on-quarter drop, we are still talking about a headline index that is higher than the previous troughs, including the early 2020 trough and also the early 2021, which coincided with the fourth wave outbreak. So this time around, just based on the absolute level of the index, we are still better than those two troughs. And you can in part explain it by saying that a lot of the SMEs this time around are better prepared for this round of the outbreak. But also I think more importantly is that we are benefiting from prior recoveries. Last year, our SME index actually recovered quite nicely throughout the last 3 quarters of last year. So we have now a higher starting point for it to drop from. So I think that also helped. The other so small bright spot is that, as Edmund shared earlier on, and that is certain industries are expressing quite positive feedback or expectations coming out from the government's electronic consumption voucher scheme, especially for the retail industry and the accommodation and food services industry. They have a pretty substantial share of respondents saying that they are positive. They see positive impact from this voucher scheme. So what this implies is that the government support certainly would go a long way in helping the local industries to recover. So given the narrowness of the voucher scheme's benefits, it makes a lot of sense for the government to keep rolling out broader schemes to help the local industries. So the recent employment support schemes and other government fundings to help the unemployed, all those are a good start. But eventually, if past history is any guide, the biggest hurdle that needs to be cleared before Hong Kong can recover for good is that we need to see a further unwinding in the social distancing measures and the travel bans and etc. etc. So I understand that takes time, but once we see that happening, I think SME sentiment will also recover more evidently. Just beyond the impact of COVID, I think COVID only explains part of the setback that we are seeing in terms of the sentiment index. Because of the broad-based nature, a lot of the less domestic demand-centric industries also got hit. And I think that can be explained by the fact that back in March, other headwinds also intensified, hurting sentiment. So we are talking about the escalation of the Russia-Ukraine conflict. We're talking about the continued elevation of commodity prices, high global inflation pressure, lingering supply chain disruption, and also a resurgence in COVID cases on the other side of the border in China as well, leading to a slowing growth and stringent lockdowns. So all these things created a very broad-based setback for Hong Kong sentiment, beyond just those that are vulnerable to COVID. Just want to also highlight one of the key sub-index that we have been tracking, and that is the cost sub-indices, especially for raw material costs, which continues to show a deterioration in cost pressure, especially for manufacturers and importers and exporters. That has not created as much of a problem before, simply because of a lot of the SMEs' ability to pass on higher costs to their end buyers. But as the external headwinds continue to loom and the global demand picture becomes more uncertain, I think there is also this growing worry that the ability for them to keep passing on higher costs to end users could become less easy. So in that sense, the squeeze on profit margin could also become a bigger challenge in the coming quarters. So overall, considering that we are only beginning to exit from the fifth wave and the external headwinds continue to loom, we maintain our very cautious Hong Kong GDP forecast. We are now looking at 1.2% for the full year of 2022. and this is still below what the government is forecasting, which is a range between 2 to 3.5%. We believe that our cautious forecast reflects only a modest, it's realistic to just expect a very modest partial recovery from Q1's contraction in Q2, and then we will only see a more sustainable recovery as we enter in the second half of the year. And even then, it will be still a slow one, considering that the global situation continues to be pretty uncertain. So maybe I'll stop there and happy to answer anybody's questions. Thank you.